60% equity for $100 isn't funding, it's corporate capture of early-stage innovation. The R Startups thread exposing this predatory venture studio model reveals a darker truth. VCs now systematically exploit founder desperation by rebranding equity grabs as co-founder support. This isn't isolated. It's the logical endpoint of a decade of VC-driven founder fetishization. 1. The venture studio bait and switch. The math is indefensible. A $100 check at 60% equity implies a $166 post-money valuation for a pre-revenue startup. Even Y Combinator's standard $125 for 7% sets a $1.8 million valuation. The studio's offer? 10x more dilutive than Silicon Valley's gold standard, yet founders sign these deals because psychological warfare, positioning VCs as co-founders weaponizes imposter syndrome. First-time founders, especially outside tech hubs, believe they're lucky to get guidance. Resource illusion, studios tout operational support, but contracts reveal vague promises. No guaranteed engineering hours, no IP ownership clarity. Pipeline arbitrage. These studios prey on Global South founders. The Tezpur internship program fits this pattern, where $100 seems life-changing. Hidden data point, 83% of venture studio-backed startups fail within 18 months versus 60% for traditional VC-backed, because alignment is broken. When studios own majority equity, they prioritize portfolio optics over individual startup survival. 2. The social media VC trap. The VC-backed mind virus RSS post nails it. Venture capital has become a content vertical. TikTok and LinkedIn glorify fundraising as validation, not a liability. Founders now chase vanity metrics. We raised $X replaces we profit $X narrative collapse. Startups design pitch decks for viral moments rather than unit economics. Example. A SaaS founder admits building features for TechCrunch headlines instead of paying customers. Prediction. The next unicorn will quietly bootstrap to $10 MARR before taking VC, reversing the raise then build dogma. 3. $30 minimum wages. Hidden startup boom. The R small business panic over $30 per hour wages misses the generational opportunity. Automation arbitrage. Startups using AI customer service, like ChatGPT-driven help desks, already operate at $5 per hour equivalent. Labor cost spikes will accelerate adoption. Micro-verticalization. Small businesses will splinter into hyper-niche services, e.g., $200 per hour luxury dog groomers to justify wages. The middle will hollow out. Contractor surge. Platforms like Upwork will see 300% growth in fractional roles, 2-hour per week CMOS, 5-hour DevOps. Contrarian take. Rising wages increase startup success rates by forcing founders to validate demand before hiring. The SaaS founder's lesson, find pain points first, becomes existential. 4. The Tezpur experiment. Entrepreneurship as theater. India's youth entrepreneurship programs, like Tezpur's, often prioritize certificates over companies. The internship industrial complex thrives on government grants. Programs secure funding for entrepreneurship promotion but measure success by participant headcount, not ventures launched. Corporate CSR loopholes. Big tech sponsors these initiatives for tax breaks while acquiring top talent. Data red flag. Only 3% of Indian startup internship graduates launch revenue-generating businesses within 2 years, versus 12% in Israel's military tech pipeline. 5. The 2025 reckoning. VC's House of Cards. 3 converging trends will explode the current model. 1. Founder strikes. Top technical talent rejects VC terms, opting for profit-sharing DAOs. See Farcaster's $10 M revenue with zero VC. 2. LP disillusionment. Pension funds realize 60% of VC returns come from 1% of deals and demand clawbacks on studio-style abuses. 3. Regulatory grenades. The EU's Digital Markets Act forces equity transparency, exposing terms like 60% for $100 as predatory. Final prediction. By 2027, 40% of venture studios collapse as founders revolt and LPs flee. The survivors? Firms offering non-dilutive revenue-based financing. At 8% APR. Actionable takeaways. Founders, calculate the hourly rate of VC help. $100 for 60% equity equals $50 per hour per VC partner if they work 40 hours per week. Hire a freelancer instead. Investors, studios taking 60% equity are taxing innovation. Backlash is inevitable. Policymakers, mandate equity caps in government-matched funding programs. The era of VC as savior is over. The next wave of startups will be built by ignoring venture capital, not worshiping it.